In 2020, something unprecedented occurred in the precious metals market. American Silver Eagles, the most trusted government-issued silver coin in the world, suddenly began selling for double, sometimes triple, their actual metal value. And while the silver price itself remained relatively stable, millions of investors were paying premiums that defied all economic logic. But here's what they didn't know. The authorized dealers, the U.S. Mint distribution system, and a carefully orchestrated supply narrative were all part of a mechanism that quietly transferred wealth from retail buyers to those who understood what was actually happening behind the scenes. The question isn't whether you overpaid. The question is, do you know how to recognize when it's happening again? Welcome to Silver Radar. Now, if you've been around the block a few times, seen a few market cycles, maybe remember when silver was still under $5 an ounce, then you know the value of solid, no-nonsense analysis. Do me a favor. If you appreciate straight talk about precious metals without the hype, go ahead and hit that subscribe button down below. We're building a community of serious investors here. Folks who want the real story, not the sales pitch. And I'm curious, where are you watching from today? Drop your location in the comments. Let's see where the savvy silver investors are gathered. Now, let's get into what actually happened. March 2020. Financial markets collapse in a way not seen since 2008. The Dow Jones loses 3,000 points in a single day. Pension funds evaporate. Retirement accounts bleed red. Panic spreads faster than the virus itself. Investors abandon paper assets, searching desperately for something real, something they can hold. Gold vaults past $700 per ounce. Silver begins its climb. But one particular silver coin becomes the obsession of millions. The American Silver Eagle, 1 ounce of 99.9% pure silver, the eagle design on one side, Lady Liberty striding confidently on the other. Since 1986, this coin has been America's official silver bullion piece. Trusted, government-backed. The gold standard of silver investments. For 34 years, buying silver eagles followed a predictable pattern. Check the silver spot price, add a small premium, purchase complete. In 2019, silver traded around $16 per ounce. Silver eagles sold for $18 to $19, a premium of roughly $2 to $3. Dealers explained this markup covered production costs at the U.S. Mint, distribution expenses, and a modest profit margin. Investors accepted this. The premium was reasonable, transparent, fair. Then March 2020 arrived, and the entire pricing structure detonated. Silver spot price climbs to $24 per ounce. Not dramatic. A 50% increase from the previous year, but nothing catastrophic. But Silver Eagle retail prices, they don't just climb, they skyrocket into incomprehensible territory. $35 per coin, then $40. Some dealers quote $45, even $48 per Silver Eagle. Mathematically, this makes no sense. The silver inside the coin is worth $24. The premium has ballooned to $16, $20, $24, a 100% premium. Investors are paying double the metal value. Experienced precious metals traders stare at their screens in disbelief. This violates every principle of bullion pricing. Meanwhile, 1 ounce silver bars from private mints sell for $26. Generic silver rounds trade at $27. Both contain identical silver content. Canadian silver maple leafs, equally pure, equally government issued, available for $29. Austrian Philharmonics at $28. The same ounce of silver, different forms, price differences of $15 to $20 per ounce. Yet buyers flood the market for silver eagles specifically. Dealers report inventory vanishing within hours of restocking. Online precious metals forums explode with questions. Why so expensive? Will premiums drop? Should I buy now or wait? The answers from dealers are vague. Supply chain disruptions, unprecedented demand, temporary shortage, wait times extending to 6 weeks, 8 weeks, 12 weeks. Retail investors face a choice: pay the inflated premium now, or risk prices climbing even higher while waiting. Most choose to pay. Credit cards, process, bank transfers, complete. Millions of dollars flow from individual investors into a system they don't fully understand. But here's what those investors didn't know. The U.S. Mint never stopped production. In fact, 2020 Silver Eagle production would eventually reach 30 million coins, one of the highest outputs in history. So where were these coins going? Why couldn't retail buyers access them at reasonable prices? The answer lies not in silver scarcity, not in production failures, but in a distribution system designed decades ago. A system where authorized purchasers hold absolute control, where transparency doesn't exist, where retail investors are the last to know and the first to pay. Those silver eagles weren't bought directly from the U.S. Mint by everyday investors. They couldn't be. They traveled through authorized purchasers first, middlemen with exclusive access, gatekeepers who determined what the retail market would pay. And in the chaos of 2020, these gatekeepers recognized an extraordinary opportunity, an opportunity that would transfer hundreds of millions of dollars from retail investors' pockets into theirs. But the mechanism, the precise system that enabled this wealth transfer, remained invisible to those paying the premiums. Until now. Behind every Silver Eagle sits a system most investors never question, a distribution network built in 1986 when the coin was first authorized by Congress. The law is explicit. Only the United States Mint can produce American Silver Eagles. No private mint, no foreign manufacturer. Only one source. This creates immediate vulnerability. Single point failure, no competition. No alternative supply when disruptions occur, but the restriction doesn't end there. The U.S. Mint doesn't sell directly to the public. Never has. Instead, it designates a select group of authorized purchasers, roughly a dozen companies with exclusive buying privileges. These authorized purchasers must meet specific criteria, minimum net worth requirements, trading volume thresholds, financial stability guarantees. Once approved, they become the only entities allowed to buy Silver Eagles directly from the mint at production cost, plus a small premium. The mint charges approximately $2 above the spot price. If silver trades at $24, authorized purchasers pay $26 per coin. From there, these purchasers distribute to retail dealers, regional distributors, online platforms, coin shops, pawnbrokers. Each layer adds markup. Each hand that touches the coin extracts profit. In normal markets, this system functions adequately. Competition between authorized purchasers keeps wholesale prices reasonable. Retail premiums remain predictable. But March 2020 wasn't normal. The pandemic triggers simultaneous supply and demand shocks. The U.S. Mint facility in West Point, New York, the primary production site for Silver Eagles, implements COVID-19 safety protocols, reduced staff, social distancing requirements, shift rotations to prevent outbreak clusters. Production slows dramatically. April 2020 sees Silver Eagle output drop by 60% compared to the previous year. Meanwhile, demand explodes in the opposite direction. Investors flee stock market volatility. Central banks announce unlimited money printing. Inflation fears escalate. Silver Eagle orders flood into authorized purchasers at unprecedented volume. Orders that cannot possibly be fulfilled with current inventory levels. Here's where the system reveals its fatal flaw. Authorized purchasers face no obligation to maintain fair pricing. No regulatory oversight governs their markups. No transparency requirement forces disclosure of their actual costs. They recognize the situation immediately. Demand exceeding supply by multiples. Retail desperation creating price insensitivity. A perfect arbitrage opportunity. Wholesale prices to dealers begin climbing, not gradually, aggressively. Authorized purchasers that previously charged $28 per coin now quote $32, then $35, then $38. Retail dealers, already operating on thin margins, add their own markup to survive. A coin purchased wholesale at $38 sells retail at $43, then $45. Market forces pushing prices into territory that defies the underlying silver value. But the authorized purchasers possess another advantage, inventory timing. While the U.S. Mint reduced production in April and May, it never stopped completely. Coins continued rolling off production lines, millions of them. These coins went directly to authorized purchasers. They decided when to release inventory to dealers. They controlled the flow. Economic strategy suggests a rational approach. Release inventory gradually. Maintain scarcity perception. Maximize profit per unit rather than volume. Some authorized purchasers did exactly this, holding back inventory while premiums climbed. Allocating limited quantities to dealers to sustain urgency. Retail investors saw out-of-stock messages on dealer websites. They interpreted this as genuine shortage. They didn't see the warehouses holding hundreds of thousands of coins waiting for optimal pricing. The information asymmetry was complete. Authorized purchasers knew production levels. They knew incoming inventory. They knew the shortage was temporary and manufactured. Retail investors knew none of this. They saw only scarcity messaging, delay notifications, rising prices. By summer 2020, the premium structure had completely detached from production reality. The U.S. Mint reported robust Silver Eagle production for the year, over 30 million coins, second highest production in the coin's history. Yet retail premiums remained at historic highs. $40 Silver Eagles became normalized. Some dealers pushed toward $50 for immediate delivery. Generic silver rounds, produced by private mints without the authorized purchaser bottleneck, traded at $27 to $29 throughout the same period. The premium differential between Silver Eagles and generic silver reached $15 to $20 per ounce for the identical amount of silver. Investors paid this differential, believing government backing justified the cost, believing official U.S. Mint production meant superior value retention. They didn't understand they were paying for distribution system inefficiency, for authorized purchaser profit maximization, for a supply chain designed to concentrate wealth rather than distribute it fairly. The authorized purchaser system, created to ensure quality control and prevent counterfeiting, had become the mechanism for the largest wealth transfer in modern precious metals history. And the transfer was just beginning. Every market crisis creates two groups: those who understand what's happening and those who react emotionally. Spring 2020 produced emotional reactions at scale. Federal Reserve announces unlimited quantitative easing. Treasury prints trillions in stimulus. Currency debasement becomes official policy. Investors who never considered precious metals suddenly become experts overnight. YouTube videos about silver stacking accumulate millions of views. Reddit communities grow exponentially. Facebook groups dedicated to silver eagles multiply. The narrative solidifies quickly. Paper currency is doomed. Tangible assets are salvation. Government-issued coins are safest. This narrative isn't entirely wrong. Precious metals historically preserve wealth during currency crises, but the conclusion that any premium is justified becomes the costly error. Social media amplifies urgency. Posts showing Silver Eagle purchases generate hundreds of comments. I got mine before they sold out. Price is going higher tomorrow. Buy now or regret forever. FOMO, fear of missing out, becomes the dominant purchasing motivation. Not careful analysis, not price comparison, pure emotional reaction to perceived scarcity. Dealer websites display countdown timers. Limited quantity available. Pre-order now for delivery in 8 weeks. Prices subject to increase without notice. These aren't neutral product descriptions. They're psychological triggers designed to override rational calculation. And they work spectacularly. First-time precious metals buyers enter the market with zero baseline knowledge. They don't know historical premium ranges. They can't distinguish between temporary shortage and permanent scarcity. Dealers recognize this information gap immediately. Marketing materials emphasize official government coin status, highlighting U.S. mint production, stressing legal tender face value. What they don't emphasize, the face value is $1, meaningless compared to the $40 purchase price. What they don't explain, government minting doesn't guarantee premium retention. The comparison with other silver products becomes deliberately obscured. Generic rounds are dismissed as unbranded, foreign government coins labeled less recognizable. Only American Silver Eagles presented as true investment-grade silver. Experienced investors know better. They understand silver is silver regardless of the mint. 1 troy ounce of 99.9% purity holds identical value whether stamped with an eagle or a maple leaf. But experienced investors are not the target market in 2020. The target is the frightened newcomer watching their 401k collapse, searching for safety, willing to pay any premium for perceived security. The authorized purchasers and major dealers coordinate messaging without explicit collusion. No conspiracy needed. Aligned incentives produce aligned behavior. Every dealer benefits from elevated premiums. Every authorized purchaser profits from the markup multiplication. The system rewards scarcity messaging even when scarcity is manufactured. June 2020 brings a revealing moment. Silver spot price drops from $28 back to $24, a 14% decline in the underlying metal value. Economic logic suggests Silver Eagle premiums should compress. If silver itself becomes cheaper, finished products should follow. Instead, premiums expand further. Dealers cite increased production costs and supply chain uncertainty. Silver Eagles now selling at $42 despite silver dropping to $24. The premium reaches $18 per coin, 75% above metal value. Retail investors who bought at peak prices watch their silver drop in value while their premiums remain locked. They paid $45 for coins now containing $24 of silver. To break even, silver must rally to $45, an 88% increase from current levels, or premiums must remain permanently elevated. Neither scenario is likely, but the realization comes too late for millions of buyers. Meanwhile, the parallel market thrives with rational pricing. Silver bars from refineries like Sunshine Minting or Geiger Edelmetall trade at $26 to $27, $3 to $4 premiums. Normal, sustainable, honest. Investors choosing these alternatives preserve wealth. Those fixated on Silver Eagles destroy it. The psychological attachment to the Silver Eagle brand becomes the liability. Brand loyalty, normally a marketing asset, transforms into a wealth extraction mechanism. Coin collecting forums reveal the cognitive dissonance. Buyers justify their premium payments by citing collectability and numismatic value. But Silver Eagles are bullion coins, not rare collectibles. Mintage in tens of millions annually. The rationalization intensifies losses. Investors unwilling to admit overpayment, holding coins, hoping premiums normalize, refusing to sell at a loss. Behavioral economics identifies this as the disposition effect. Holding losers too long while selling winners too quickly. Authorized purchasers faced no such psychological constraints. They sold at peak premiums, locked in profits, no emotional attachment to inventory. By late 2020, the premium structure begins showing cracks. U.S. mint production reaches full capacity. Dealer inventory accumulates. Retail demand softens as unemployment benefits expire and economic fear subsides. Premiums start declining. $45 becomes $42, then $38, then $35. Investors who bought at peak realized the premium was never sustainable. It was extractive, temporary, a wealth transfer mechanism disguised as market dynamics. The lesson should be clear. Understand what you're buying. Question artificial scarcity. Recognize when brand premium exceeds rational value. But markets have short memories, and the system remains unchanged, waiting for the next crisis, the next wave of frightened investors, the next opportunity to extract wealth from those who don't understand the game. By early 2021, the Silver Eagle premium crisis reaches its inevitable conclusion. Market forces, delayed but not defeated, begin reasserting control. U.S. mint production stabilizes at pre-pandemic levels. Monthly output exceeds 2 million coins consistently. The supply constraint that authorized purchasers leverage dissolves. Dealer inventories shift from scarcity to surplus. Websites displaying out-of-stock messages now show in stock with immediate shipping. The urgency narrative collapses. Retail demand weakens simultaneously. Stock markets recover. Bitcoin captures speculative attention. The desperate flight to tangible assets subsides. Silver Eagle premiums begin their descent. $45 becomes $40, then $38. By mid-2021, premiums compressed to $32 with silver spot at $26. Still elevated compared to historical norms, but the peak has passed. The extraction phase concludes. Now comes the accounting, the measurement of winners and losers in this wealth transfer event. Authorized purchasers emerge as clear victors. They purchased coins from the U.S. Mint at $26 to $28 throughout the crisis. They sold to dealers at $35 to $40. Pure margin capture on millions of coins. Conservative estimates suggest authorized purchasers extracted between $200 to $300 million in excess profits during 2020 alone. Money that flowed directly from retail investor accounts into their balance sheets. Major online dealers also profited substantially, operating on higher volume with markup percentages that expanded during the crisis. Their profit margins doubled or tripled compared to normal years. Retail investors who bought Silver Eagles at peak premiums face a different reality. Those who purchased at $45 now hold coins containing $26 of silver. To break even requires either silver rallying to $45, an unrealistic 73% increase, or selling to another buyer willing to pay the same inflated premium. Neither option materializes for most. The secondary market for used Silver Eagles offers buyback prices reflecting spot plus modest premiums. Dealers offer $28 to $29 for coins purchased at $45. 35% loss locked in, wealth destroyed through premium overpayment, not through silver price decline, but through distribution system exploitation. Meanwhile, investors who purchased generic silver rounds, bars, or foreign government coins at $27 to $29 experience minimal loss. Some break even. A few profit if they timed purchases during silver's dip to $24. The differential outcomes are stark, same metal, same time period. Dramatically different results based solely on product selection and premium awareness. The crisis exposes systemic vulnerabilities that persist beyond 2021. The authorized purchaser system remains unchanged. No regulatory reform, no transparency requirements, no consumer protection measures. The U.S. Mint continues its passive distribution model. It produces coins. It sells to authorized purchasers at fixed markup. It bears no responsibility for retail pricing. Congressional hearings discuss the issue briefly. Testimonies submitted. Reports filed. No legislation passes. The status quo prevails. This creates certainty about the future. The same mechanism will activate during the next crisis. Different timing, different trigger, identical wealth extraction structure. For strategic investors, the lessons crystallize into actionable intelligence. First lesson, understand premium structures before purchasing. Every dollar paid above spot represents cost, not investment. Premium compression destroys wealth regardless of metal price movement. Second lesson, brand loyalty in commodity markets is expensive psychology. Silver is silver. Government minting doesn't change molecular structure or intrinsic value. Third lesson, scarcity claims require verification. Manufactured shortage differs from actual shortage. Production data, mintage figures, and alternative product availability reveal the truth. Fourth lesson, emotional urgency indicates exploitation. Legitimate investments don't require countdown timers or fear-based marketing. Pressure tactics serve sellers, not buyers. Fifth lesson, information asymmetry is the enemy. Those who understand distribution systems, production capacity, and historical pricing patterns capture wealth from those who don't. The Silver Eagle premium crisis of 2020 wasn't an anomaly. It was a feature of the existing system operating under stress conditions. Authorized purchasers didn't break rules. They exploited structural advantages built into the distribution model. They maximized profit within legal boundaries. Dealers didn't commit fraud. They charged what the market would bear. Supply and demand dynamics, even when artificially influenced, remain legal. Retail investors weren't victims of crime. They were participants in a system designed to extract maximum value from information disadvantage. The policy question remains unresolved. Should the U.S. Mint reform its distribution model? Direct-to-consumer sales would eliminate the authorized purchaser bottleneck. Price transparency would follow. Other government mints operate this way. The Royal Canadian Mint sells directly to the public. The Perth Mint in Australia offers similar access. Both maintain stable premium structures. But changing the U.S. system requires congressional action. Authorized purchasers represent powerful commercial interests. Reform faces significant resistance. Until that changes, if it ever does, the system persists, ready for the next crisis, the next wave of frightened investors, the next opportunity for wealth extraction. The permanent lesson transcends Silver Eagles specifically. In any market, understanding structure matters more than following crowds. Information advantage determines outcomes, and premium paid today directly reduces wealth tomorrow. Those who learned this lesson in 2020 positioned themselves strategically for future opportunities. Those who didn't will likely repeat the same expensive mistakes when fear returns. Because fear always returns, and systems designed to profit from fear never reform themselves. The choice belongs to individual investors. Understand the game or finance those who do.